So my name is Ruth Kozan. I am one of the retirement information consultants. And the objective this afternoon is really just to sort of bring you up to speed on the lifetime pension because it is a new product. We want to give you some of the highlights of how it works. We want to talk about why it might be valuable to you to add sort of to your arsenal of retirement income. So it is designed to provide you with that long-term financial security, but it might be a product that is actually used in conjunction with some of the other options that you have within PEPP as well. So as you sort of see how the product itself is working, then that would be a decision that you'll come to as we look at the big picture. So the workshop's being brought to you by Planera Pension and Benefits and being presented this afternoon by the Retirement Information Consultants, and it's our team of consultants that's working in the background to answer your questions in chat there. Keep in mind that the information that you're putting into chat, if you are choosing to go that route, can be seen by everyone. So please don't enter any personal information in there at all. And know that our team will be available to you during the work week, so business hours, to answer any additional questions that you have or just provide some additional clarity there. So this is a look at our team, and you will see that the retirement information consultants, that each of us have a financial planning designation. And when you are talking to the retirement information consultants, we have a lot of information about your pension. We have a lot of information about your options and that type of thing. But we're also trying to help you look at the big picture. It is really important to us that you're comfortable, that you understand what your retirement choices are, what your retirement income options are going to be, and really just helping you look at financial wellness in general. So we're not providing you with advice, but we are helping you to understand how the taxes are going to work and why you might choose one product as opposed to another one, or how you might choose to split up your income sources and sort of have different avenues of income coming in. How is that going to be complemented by your CPP and your OAS and maybe other personal savings that you have? So the retirement information consultants, again, just want to help you look at the bigger picture. And we do have a team here that's always willing to help you out. In addition to doing these webinars, you may have also seen us out in your community or in Regina for sure, putting on workshops that we do in person. And we do have a full slate of workshops that's available. This one, I mean, it's 1 hour. It's going to focus on that lifetime pension benefit, but we do have full day workshops that we do as well that just get you thinking about all the things you should be thinking about as you head into retirement. And then we have some for the younger folks as well, as they're managing potentially more debt and family and kids and mortgages and that type of thing. So lots of information is available to you because you are a member of the plan. So we are just going to hop into the presentation here. I do have a video that I'll be playing for you that's going to give you an overview of the product in general. And then as I go through the rest of our presentation, we're going to take a deeper dive into some of the areas. But bear with me now as we take a look at this video.
Introducing our new lifetime pension. Retiring or retired members can now move some of their PEPP money into our lifetime pension. It's designed specifically for those who'd like to receive a monthly retirement income for life. So, how does it work? Your money goes into a pool with other lifetime pension members, and these funds are invested in PEPP's Moderate Fund. The lifetime pension has an annual rate of return goal of 4%, also known as a hurdle rate. However, the Moderate Fund's annualized rate of return is typically higher than 4%. For example, if the Moderate Fund's rate of return for the year is 5%, Your lifetime pension payment for the next year will increase by 1%. The following factors may help you decide if our lifetime pension could be an essential part of your retirement plan and a better fit for you than traditional income options, including annuities offered by insurance companies. Payments are influenced by market performance. Your payments may be adjusted up or down from year to year depending on the fund's performance compared to the 4% rate of return goal. But in the long term, we expect payments to increase, helping you mitigate risks in retirement. There are no commissions when you buy. You continue to benefit from PEPP's lower fees and professional investment management. You share risk with others in the fund. You'll receive monthly pension payments from a pooled amount. Given that some people live longer than others, the pooled money can be invested with a longer risk horizon, meaning a dependable monthly income for everyone for the rest of their lives. You may have heard about longevity risk. We're living longer than ever, which increases the risk we might outlive our retirement savings. Planning for this possibility is an important step in having a more financially secure retirement. Our lifetime pension can help reduce longevity risk by providing you with a dependable monthly income for as long as you live. And should you pass away, you have options for your spouse to continue to receive payments for the rest of their life, or for your beneficiaries to receive payments until the end of a chosen guarantee period. PEPP's retirement information consultants are here to help you understand the lifetime pension, how it can be combined with our other retirement options, and whether it's a good fit for you. Visit us online to learn more and to view a full list of upcoming webinars on the PEPP website.
All right, so just to proceed on there, that really gives you sort of a glance, at a glance, what that looks like in terms of the lifetime pension. So we're going to take a little bit of a deeper dive here. And what we want to talk about here is the fact that that it is an option that's available. So may not suit everyone. And in addition to that, it might be something that can be used as a complementary product. So the design of the product was actually that it be used in conjunction with the variable pension benefit. Now, we're not going to spend a lot of time on the variable pension benefits. Some of you are already in it. If you're not familiar with it, it is one of the retirement income products that are available and that we learn about in the Prepare workshop when we do that. But it's a flexible product where the lifetime pension is designed to provide you with a dependable income stream for your lifetime. So how it works is it is a product that you would be putting your money into, and then that is going to put back out to you monthly payments for as long as you're alive. The longevity risk, you're pooling longevity risk there, and that's sort of the beauty of the plan, is that your assets are pooled with other members, and those funds will be invested into our moderate fund. So again, it's one of the options that's available to you in your PEPP account right now or in your variable pension benefit. And that's where we will be putting the money that's put into the lifetime pension. The payments will be adjusted annually, then based on the performance of the moderate fund. So it's all going to be linked around that moderate fund. It is going to be reassessed on an annual basis. And at that point, those payments, monthly payments that you're receiving, if the moderate fund has performed well, those payments could be increased. If the moderate fund has not performed up to that 4% expectation, we'll describe that a little bit later, then your payments could be adjusted downwards as well. So on an annual basis, we're looking at the plan. We have actuaries that are going to be evaluating it, and any adjustments would be applied in June of each year. So the fact that they are looking at it on an annual basis, and also in addition to an interest rate change in the moderate fund, there can also be a mortality adjustment there. And that is what's going to ensure that the fund is fully funded going forward, and that we can continue to provide those lifetime benefits to members. So when we look at who's eligible to participate in this plan, the member must be at least 50 years of age and no older than 94 is actually the highest, so younger than 95. The initial amount that you could put into the lifetime pension, so the amount that you're depositing into there for 2025 would be 14,260 would be the lowest amount. That number has been determined because it's 20% of the YMPE. Having said that, though, $14,000 into the lifetime pension benefit is not going to generate a very large monthly income there. The most that you can put in to that lifetime pension will be $1 million. And funds that are going into there do have to be funds that are locked in under Saskatchewan legislation. So funds that are in your PEPP account already, those are being governed under Saskatchewan pension legislation, and therefore any of that money that's going into the lifetime pension would also be Saskatchewan legislation. So in terms of investment performance, again, the decision has been made to link that performance to the moderate fund. And we're starting out with what we call a hurdle rate, or a rate that we believe we can achieve, which is 4%. And then that's going to help to dictate what the payments during the first period of time that you're receiving from the lifetime pension. And then after that, they will be adjusted based on the moderate fund and the longevity experience within those that are pooled and in that lifetime pension. So there is going to be a mortality adjustment there as well. And again, those payments would be changing in June. So just to describe what that is, so with the lifetime pension, they do have a term that they use, which is called the hurdle rate. And the hurdle rate for the lifetime pension will be set at 4%. Basically, that is a rate that we believe that we can achieve, and where we would use it as a baseline for your payments starting in that initial year. It represents the goal for what the moderate fund would achieve. And then again, once we've gone through that full year and into June, the payment in June could be adjusted upwards or downwards based on the performance of the fund. So we just have a very simple example here, and we've got more information coming up as well. A look at how that might work. So the moderate fund in 2024, and this is based on the fiscal year, so ending March 31st, the return on the moderate fund was 8%. So had someone been in the lifetime pension for the year prior to that, the goal rate that had been set was 4%. That's what their initial payments would have been based around. The difference, because the moderate fund did return 8.8%, means that their payment for the following year would be increased by 4.8%. If, however, the moderate fund had had a negative return, so if we had a negative 3% return, we didn't match that hurdle rate. So therefore, their payment for the next year would be decreased by 7%. So we're not talking about the amount of money that's in the plan or anything is being decreased by 7%. We're saying the payment that you were receiving the year prior to this would be reduced by 7%. Okay. And then each year following that, there'll be a review based on the hurdle rate, the actual performance of the moderate fund, and then the potential for a longevity adjustment there as well. So we did plot this information again. We've back tested it now. And a little review here will indicate how the funds in the moderate fund are invested. So the targets there are to have about 27.5% of the funds in the moderate fund are invested in equities or the stock market. We also have alternatives at 27.5%. Those alternatives are represented by real estate, infrastructure, commodity, currency. They've recently added some farmland and timberland to those alternative investments. And then 45% of the funds are invested in bonds or fixed income there. So that's the asset allocation within the moderate fund. And this is a look at the actual rates of return that have been received on the moderate fund historically. So you can see again in 2024, it was up 8.8%. You can also see that in 2022, it was down 8.4%. So had the product existed in that period of time, then in that particular year, so the year following that, after we knew what the return was, your payment would have been adjusted downwards. But overall, we believe, just historically based on the markets and so forth, that over time, these payments will continue to go up. They're not going to go straight up, but they will sort of, on an up and down basis be going up there. And for that reason, we believe that it is more likely to be able to keep you up with inflation than to simply just have a product that's paying you out a flat rate for the rest of your life. So here's just another example of a payment schedule and what that might look like based on rates of returns. So again, in that initial period of time, your payments are based on that 4% hurdle rate and then could be adjusted upwards or downwards. So when we look at this slide, we assumed that the initial payment here would be $515. If the fund that year had returned a rate of return of 5.3%, then your payment would be adjusted upwards. So the calculations that were done here, whereas if you had started, if the product had existed in 2019, this is someone who's 65 years old, their spouse is also 65 years old, and based on a $100,000 deposit. You can see that in 2020, the assumption was made that the fund had done 6%. So your payment again was adjusted upwards. Similar in 2021, a good year there, payment was adjusted upwards. But then if there had been a negative return of 8.4%, then your payment would be adjusted downwards. So downwards by the hurdle rate and the negative return in the market. So again, just trying to give you a sense of how those payments might be adjusted. But it is always going to be based on, looking back historically does not mean that that's what the returns will be in the future. And it will be, each of those will be taken into account. So we've just added another slide that basically presents it in a little bit different way. I think we all sort of learn differently and see things differently. The important thing to remember here is when we're showing you how the payments would be affected, the thing to remember is that this is being based just on past returns of the moderate fund. Each year, there could be a small adjustment for the mortality adjustment. So the actuary is taking a look at who's in the plan. Did they live longer than we thought they were going to? Have more of them passed away early than we thought we're going to? And there can be an adjustment, small adjustment there as well for that the actuary applies there. So they would do that assessment on an annual basis. So keeping in mind that this chart is only reflecting the actual rates of return of the moderate fund, and the actuaries numbers are not built in here, although it has been indicated to us that those are likely to be very small adjustments on an annual basis. So again, just sort of a picture to describe how the actual product will be working and when the adjustments will be made. So right now, what we will be doing as we kick the product off, we will be taking applications in March for the product, and your first payments then would begin at the end of April. What will happen is you will continue to receive those monthly payments. Um, by March 31st, we will know what the performance of the moderate fund has been for the previous year. And so the actuaries will be taking that information. They'll be looking at, again, the mortality factors inside the funds. And by the beginning of June, those members that did join will be sending out information to you to tell you how your payment will be adjusted at the end of June. That payment, once it's been set for the end of June, will continue on for the entire next year. And again, in March of the following year, we'll know the performance. The actuaries will take some time to do their calculations, and your payment would be adjusted again the following June. You don't have to just join the plan in March. It will be a perpetual offering, and any changes in or adjustments in the payments to you would be prorated for the length of time that you were actually invested in the product itself. So that's how it will work. We'll be notifying you in June if there are adjustments, whether it's up and down, and then that will set the course for the following year. In terms of receiving the actual payments from the lifetime pension, this is true whether you're in the variable pension benefit or the lifetime pension or the life annuity. Our payments come out at the end of the month, and we withhold tax on the payroll tax system. So when you're doing paperwork for any of these products, we are asking you to fill out a TD1 form. And what you report to us on that TD1 form will determine how much tax we will be withholding off of every payment. And of course, that withholding tax is just forwarded to CRA. It's prepaid taxes. You're going to get a T-slip at the end of the year, which is going to show you all the income that you've had for the year and the withholding tax that we've already submitted on your behalf. So again, each of the provinces has their own TD1 form, and then we have a federal form as well. And that will dictate the taxes. That's also a role that the retirement information consultants can play, is once we know what your payment would be set at or scheduled at, then we can help you sort of work through there and say, this is what the gross payment is, but what are you likely to receive in your bank account, depending upon how you filled out those TD1 forms. So that's certainly something that we can help you take a look at as well if you're just wanting to know. I do understand what the gross payment is, but I want to know what's going to land in my bank account, what's going to be paying for my groceries. So we can certainly help you take a look at that as well. The lifetime pension will be available for pension income splitting. So pension income splitting with your spouse. It is considered to be eligible pension income at any age. So if you have retired, so you're no longer working with your PEPP employer, and you've moved some of your funds into the lifetime pension and you're 55 years old, then that would be considered to be eligible pension income and would be splittable with your spouse. Just a side note there is with the variable pension benefit, which is also one of the products that's available to you or you might be in already. Income from the variable pension benefit, a RIF or a PRIF, is not eligible pension income or is not actually splittable until the member is age 65. Income from a life annuity, a defined benefit plan, or the lifetime pension is, in fact, qualifies for income splitting at any age. And why might you consider the income splitting? So this is just a very basic example here. In this case, we're saying that we have a couple, Jack and Jill, and Jack has pension income of $60,000 a year. Jill, however, doesn't have a pension plan um, at all, did not work outside the home, or had much lower income for a period of time. And so, what if Jack were to take that $60,000 into income himself? We are looking at an example here where he would pay approximately $8,000 in taxes. If instead they income split that, and Jill takes $30,000 into income and Jack takes $30,000 into income. Between the two of them, their tax bill is likely to be closer to this 4,964. So across the household has saved approximately $3,000 in taxes. When we talk about income splitting, this does not mean that actual money is changing hands. So PEP is not going to have this deposit of yours in the lifetime pension and send part of the check to Jack and part of the check to Jill. Jack is going to receive all the money, but this is an entry that you would do on your tax return. And you're going to do it each year in a way that makes the most sense to you. So what I'm suggesting there is maybe in the first year, they actually did split it 50-50. But the following year, maybe Jill went to work for a period of time and had her own income. Then maybe it doesn't make sense that she take in 30,000 from Jack's. Maybe it makes more sense if she takes 20 and Jack claims 40. So you do have the flexibility there to adjust that every year, and you're doing that on your tax return, or you or your accountant or your TurboTax is doing that so that it works out the most efficiently for the family. So in terms of a payment option, just to be clear on the different choices that you have with the lifetime pension, is you can have a single or a joint lifetime pension. If you do have a spouse, then you would be choosing, and you have the option of a survivor benefit of 60% or 100%. And then we have guarantee options as well. So we're going to take a look at those and give you a little more detail around how that works. So this is just a look at a guarantee period for someone who is single. So if you are single, you can take the single life annuity. If you do have a spouse, your spouse would have to sign off on a survivor benefit. So they would basically give you approval to take a single life annuity selection. And in this case, the choice had just been made for a 15-year guarantee. So what the guarantee period means is how long someone will receive your payment. Now, if it's you, it's a lifetime. So the guarantee period is not really about you, or what it is if you were to pass away, how long someone may collect your payment. So in this case, we are demonstrating a 15-year guarantee. If you live for 10 years, then you're going to get your payment for 10 years. But if you pass away after that 10-year period, then there would still be 5 years left in that guarantee period, and those payments would go to your estate or beneficiary. Okay, if you live 25 years, you're going to continue to receive your payment for 25 years. So as long as you're alive, you're going to receive your payment. Okay, if you were to pass away early, then again, your estate or beneficiary, someone will continue to receive that payment till the end of the guarantee period, and then there would be no further payment to anyone. Keeping in mind that this is a look at what would happen if you had opted for this single lifetime pension and a 15-year guarantee period. In the next scenario, we're going to look at someone who does have a spouse and has chosen a joint survivor option within that lifetime pension, they've chosen a 10-year guarantee and a 60% survivor benefit. So we're going to take a look at how that would, how those payments would be impacted. So again, you're receiving your payment. If you live for 1 year, you're going to receive your payment for 1 year. If you live for 25 years, you're going to receive your payment for 25 years. However, if you were to pass away after 1 year, your spouse would continue to receive your full payment for the next 9 years or till the end of the guarantee period. And after that, it would drop down to 60% of that payment. And they would receive 60% of your payment for the rest of their life. Keeping in mind that this is a decision that you made when you signed up for it. So your choice was to leave them a 60% survivor benefit. So if you passed away and once we're outside the guarantee period, then your spouse would receive 60% of your payment. If you live for 25 years, you get your payment for 25 years. If you pass away after 25 years, your spouse would not receive your payment because we're outside that 10-year guarantee, but it would immediately drop down to 60% of that, and they would receive 60% for the rest of their life. Okay. So with a joint lifetime pension, if either you or your spouse is alive, there will still be funds coming in to the household. Once you've signed up for the lifetime pension, that is a permanent decision. So there's no changing your mind about that decision. However, if there is a marriage breakdown after that lifetime pension has been applied for, then the spouse can apply under the Family Property Act. We can divide those payments. So payments to the spouse that you had at the time when you signed up for the lifetime pension would continue to that to your spouse as long as you're alive. And it's only the spouse that you have at the time that would be eligible for this calculation on a marriage breakdown. That would be something, if that was the situation, that you would be informing PEPP of what the situation was, and they would help you to do that calculation. Okay, so when we think about using the lifetime pension and how that's going to, again, fit into the big picture, we often talk about within the financial planning industry, or when you're trying to project what your income streams are going to be going forward, a common practice would be to match your fixed income with your fixed expenses. So there are some things in retirement that we're going to want to do. We're still going to want groceries. We're still going to have to pay our property taxes and our utility bills and maybe put gas in our cars and have all those basic needs met. One of the strategies of doing that is to say, we're going to have our Canada pension, and that's going to be coming in on a monthly basis. It does have indexing there. So that's going to help us to keep up with inflation and to pay some of those fixed expenses that we're going to have. At 65, we may also qualify for the old age security. Again, that's going to be a monthly income. We can count on it. But what gap do we need to fill there to be able to meet our fixed expenses? And we believe that the lifetime pension might be the product that fills that gap. So the fact that it is a dependable payment for life can help you know that you are going to have that payment coming in each month. It might be used as a complementary feature to the variable pension benefit. So the variable pension benefit is a flexible plan within PEPP. And in that case, you are going to have a pot of money in that variable pension benefit, and you get to decide, pardon me, how quickly that money's withdrawn. So you could take out a lump sum from that variable pension benefit if you wanted to. You could still structure a monthly payment from there. The money's still invested as your PEP funds are, but you're more in control of that cash flow. So what we sometimes hear from members is that when we first retire or we're a little bit younger, we would like access to a little more cash. We want to travel. There's things we want to do. We just think we're going to be spending more money, perhaps, than what we will be maybe in our late 70s or 80s. And we want to make sure that we do have income that is going to last a lifetime, but we do appreciate having a little more flexibility up front. And that's why we think that these two products might work very well together. So the variable pension benefit, having a flexible payment schedule or the option to take a lump sum, maybe if an emergency comes up or something. And also with the variable pension benefit, you're not locked into that product. So you could still, you could purchase a lifetime pension now with some of the money. And in 10 years from now, you're like, you know what, I really like this guaranteed payment, or the fact that this payment's going to come in on a monthly basis. And you may put more money into that lifetime pension down the road. The structure, of course, is going to be different because you're older, and you would actually end up with two sets of money coming out of the lifetime pension. With the lifetime pension, the benefits of it, of course, is that you do have this dependable income for life. Although it is fluctuating, can fluctuate, you know that you will be, as long as you're alive, you are going to be receiving a payment from there. So other things that you should be considering, and things that we'll talk to you about as well, is with the variable pension benefit, there is a risk of outliving your savings. So depending upon how quickly you're drawing down funds out of that variable pension benefit, if they are drawn down too quickly and you end up living longer than what you had sort of anticipated, there is a risk that you may run out of funds there. And some people may feel like they need to put aside additional savings just to make sure that there are still funds available. With the lifetime pension, you are going to have dependable payments for life. We believe that the pooling of funds and the returns on that moderate fund, that there's a very good possibility that that will help to protect against inflation. But keeping in mind that the enrollment is permanent. So once you put funds into the variable pension benefit, or sorry, into the lifetime pension, then that's a done deal. You're just going to receive that payment for a lifetime. We also have a product, which is the Saskatchewan Pension Annuity Fund. So it is a lifetime benefit there as well. The difference is when we tell you what that payment is, that's the payment that you will receive for the rest of your life. So it is not a product that is going to be sort of defending you against inflation. The Saskatchewan Pension Annuity Fund, although the payment isn't fluctuating at all, it could be deteriorated over the years just because of inflation. So enrollment in that product is also permanent. So whether you're putting funds into the lifetime pension or into the Saskatchewan Pension Annuity Fund, both of those are contracts that are established at the time, and you're not able to change your mind later in terms of, I like a lump sum out of here, or I decided I don't want to do this anymore. Those are permanent decisions. So things that you should consider if you're thinking about the lifetime pension. And again, these are our conversations that the retirement information consultants would be happy to have with you. Things to keep in mind is that payment can go up and down based on market performance. Like all funds, in PEPP, there is no commission to actually purchase that fund. So there are expense ratios that are associated with each of the funds that you have options for in PEPP, but there's no additional fees over and above that. There's no commission. Nobody's making any extra money on the side there. And because of the pooling of funds, you are sharing the risk with other members of the fund. For that reason, you're not just deciding on a single investment yourself or needing to make the decision of how much can I take out of here to make sure that these will last a lifetime. The risk there is going to be shared across all the members of the lifetime pension. So you may have taken a look around already. Hopefully you did, or if not, what I will tell you is that there is plenty of information on the PEPP website regarding all of our products and about the lifetime pension as well. So we do have a calculator that's available on there, and you're welcome to go in there. You can take a look at the a single life annuity or single lifetime pension there. If you have a spouse and you're interested in providing or taking a joint pension, then you can do that as well. And it does give you an idea there. It gives you an opportunity to put in the balance of your PEPP account, whether that's the PEPP account or the variable pension benefit, and then just sort of use a slider there to say, what if I put, and it defaults to putting 50% in. So if I had $400,000, what might it look like if I put $200,000 into the lifetime pension and kept $200,000 in my variable pension benefit? What might that look like? And so we do give you an estimate there as to what your initial payment from the lifetime pension would be, recognizing that it will be reset in June of the following year. But it gives you an idea of what that would look like. It gives you the opportunity to see what might be available in terms of a survivor benefit or how your payment would change. Depending upon whether you left a 60% survivor benefit for your spouse or 100% survivor benefit. And then again, we don't know what the rates of return will be on that variable pension benefit, but it shows you how you might be able to use that flexible income just to sort of complement the lifetime pension as those funds are coming in. So I would really encourage you, if you haven't done so already, to pop online and take a look at the calculator there and all the other information that's available on the website with the calculator. And then also reach out to us if you have any questions beyond that. So how would you go about if you've determined that, yeah, you know what, I do think this lifetime pension, at least with some of my funds perhaps, is something that would be appealing to me. How do you go about doing that? So someone who's retired, retiring soon, retired already, or in the variable pension benefit already, you can ask for a retirement package or option package. And in there, you would get an estimate for the lifetime pension. If you decided that that was the route to go, there's an application form that you'll be filling out for that lifetime pension. You will be selecting what those payment options look like. So is it a joint pension? How much of a survivor benefit am I leaving? How much of a guarantee period did I choose to have attached to the product? And if you have a spouse, but you're opting to take a single lifetime pension, then your spouse would need to sign a waiver in that case because they are giving up their right to a guaranteed survivor benefit, which is driven by Saskatchewan pension legislation. So just depending upon the actual route that you decide to go there, the choices that you're making with the product, that would determine the paperwork and ourselves, the retirement information consultants, or the PEP pension information officers, we'd definitely be keeping you on track there and just making sure that we had all the appropriate paperwork in place. So again, the product, we will be taking enrollments for the lifetime pension starting in March. And those who are interested and have their paperwork in by March, that first payment will be coming out at the end of April. Payments will be received on the last day of the month, and we would be withholding taxes off those payments based on how you had completed those TD1 forms. So please don't hesitate to get in touch with us, particularly because it's a new product. Um, you know, it's great to go online and read about the product and use a calculator and that type of thing. But absolutely, we are here to support you in that as well. And because it is a lot of information that we're sort of putting out into this presentation, we'd be more than happy to have a chat with you and just sort of discuss why it might be a product that might work well for you, or considerations, the things that you would want to think about before making that final decision. So we do have some contact information for you there for the retirement information consultants, and then for PEP as well, and their pension information officers who can also give you a hand there. All right, so that concludes the presentation. And so we do have a few minutes left here. So I'm just going to check in with Rejoice and see if there was questions coming in the background, or you know, sort of common questions there, or some additional maybe high points that we could hit on here just to provide some clarity.
Hi, Ruth. Yes, we do have a couple of questions here. The first one is, are you able to send out the presentation slides?
Yeah, so if you received the link for the presentation, there should have been an attachment right on there. There would have been a PDF file that was attached to that email, and that would contain the slides there. If you didn't receive that, if you made it onto the call, you've probably got those already. If not, please reach out to us again and we'll make sure you do get them.
Thank you. And the second question is here. How many months in advance do one needs to apply for the lifetime pension?
Yeah, so again, just using the sort of upcoming session, if you will, the paperwork will need to be in for March, and that will get a payment for the end of April. Paperwork that's coming in April is going to get a payment at the end of May. So, you know, a little bit of lead time just to get it set up, and then the payments would always start the end of the month and the following month that the paperwork came in. Any other questions there, Rejoice?
Oh, sorry, I was muted. The next question here says, why is this done on a fiscal year and not in a calendar year?
Yeah, so the performance of the funds have always run on that fiscal year, and so that's just how it will be operating. Is we will be looking at that fiscal year performance. It's how we've reported on the PEP funds always, and that's why we're going to be sticking with that structure. So calculations done to the end of the fiscal year, a period of time there for the actuaries to work their magic, and then adjustments to the payments would be made in June.
Perfect. Thank you, Ruth. The next one here is, what fund does your pension have to go into once you retire if you choose the VPB?
Yeah, so with a variable pension benefit, you still have the full slate of PEP funds available to you. So it doesn't have to go into any particular fund. Any investment choice that you have inside your PEP account. So while you're working, or if you haven't moved the money out, even if you've retired or terminated from your PEP employer but haven't taken any other action, you still have the full slate of PEP funds available to you. And that's also true of the variable pension benefit. So if you are no longer working with your PEP employer, you're over the age of 50 and have put money into that variable pension benefit, you still have all the same investment choices that you had when you were an active member of PEP.
Next is what happens when you turn 95 years old?
Congratulations would happen at 95 years old. Inside, if the question is what happens with the lifetime pension once you turn 95 years old, if you're still alive, you're still getting a check. So the criteria that we laid out there for you is members that are younger than 50 cannot apply for the lifetime pension, and members that are over the age of 95 cannot join the plan at that time. So those criteria were when you could get in. But if you're in that lifetime pension already, and if you're still alive at 95 or 105, you're still collecting that monthly payment. And that's sort of the security of it is, we don't know how long we're going to live. Life is unpredictable. But if we did end up living long lives, there's still going to be payments coming in from that lifetime pension.
Thank you, Ruth. Next one says, what happens to our initial investment if my spouse and I die before our payments have been distributed to us?
Yeah, so I think how you have to look at that. So let's say that we were talking about $100,000. So I put $100,000 into the lifetime pension, and how I interpret your question is, I've been taking payments here, but what if both my spouse and myself pass away before I get that $100,000 back? What you have to recognize is once that deposit is made into the lifetime pension, you don't have $100,000 anymore. You have a payment for life. So it's not a matter of getting back that initial deposit or anything like that. The payments, if both yourself and your spouse passed away early, payments are going to be made to the end of the guarantee period. And so whether you chose 5 years, 10 years, or a 15-year guarantee, if yourself and your spouse have passed away, there is no further payment to anyone. So it's not a principal guarantee. It's not looking at, did I get all my own money back? That type of thing is you're sharing that longevity risk. And hopefully you live beyond that. You can do some math just based on what your payment is and if it was only received for 15 years. But especially in the case of a member and a spouse, the likelihood of that, it is not that likely. Can it happen? Absolutely. In which case the payments would be made to the end of the guarantee period only. But I think you have to change your mindset a little bit. And I'm exchanging this $100,000 for a monthly payment for life.
Okay, for the sake of time, we'll take the next two questions. And if your questions weren't answered, you can please reach out to us on our email. The next question would be, could you confirm if the 4% hurdle rate is before fees or after fees? The current MER on the moderate fund is 1%, so the necessary market return then is actually 5%.
Yeah, so in terms of the hurdle rate, I would describe it as that is not, if I want to, it's not an investment rate. We're saying we're pretty confident we can get 4%, and this is what your initial payments are going to be calculated on. So it's not really that there's an expense ratio over and above that 4% or embedded in that 4%. It's like we're going to base our initial payments on this 4%. And then after that on the moderate fund. When you look at the moderate fund, the returns there are net returns. So if we tell you that the return on the moderate fund was 8.8%, that's 8.8% after any fees were applied to it. But in terms of the hurdle rate, that is just an initial rate that we need to use some rate to calculate the initial payment on. And so that 4%, that hurdle rate is where they landed on that. And basically that's it. It says, you know what, we're pretty comfortable that that we're able to get that 4%, and that's what we're doing our calculation on. So there's not really an expense ratio embedded in there or not. It's just that initial rate of return that's been determined that the payments would be calculated on.
Okay, and the next one says, why are members under 50 years not eligible to apply for the lifetime pension?
Yeah, so I mean, under the PEPP legislation, age 50 is the first time that you have access to those funds. So, you know, members under 50 also are not eligible for the variable pension benefit either. So that's the youngest age that you would be able to apply.
Okay, that will be all the questions we can take for today. Like I mentioned earlier, the other questions can be addressed if you reach out to us on our email or by calling in.
Okay, that's great, Rejoice. Thank you for supporting me in the back. And again, I apologize for the few technical difficulties we had there at the beginning. So thanks for joining us on a chilly Saturday afternoon. And please do feel free to reach out to us. We do understand it's a lot of information, and sometimes it's just helpful to just talk it through. Like I heard it, but did I hear it correctly? Or, you know, what would be a circumstance that I would want to try this or that? So please do research on the website, reach out to us. And in fact, I'm just going to flip back here. So here's the phone numbers again for the retirement information consultants, and an email there as well. We will not respond to very specific individual information by email for privacy reasons. But if you want to give us a phone number as well, we'll always help you to give you a call back. So thanks again for coming out, staying in this afternoon and listening to us. We do appreciate it. And we hope you have a great rest of your weekend. Take care, everybody.
Thank you, everyone. And I just want to quickly add that this video will be posted on our website in the next couple of weeks here.